Welcome to the third episode of Zero to Funded. And if you're new here, well, let me just explain very quickly what this series is and what I aim to get out of it. So this series is basically a free guide on YouTube giving you all the steps that you need, all the knowledge you need basically, including a strategy, which you can use to get funded. You don't have to waste any more time looking at videos where they just show you, risk to reward ratios, things like that. But there's no explanation behind it. This series has everything from top down, everything basically. And my aim is just to get as many of you funded, basically doing the same things that I've done myself. So if you're new here and haven't watched the previous episodes, make sure to check that out first. But without any further ado, we are going to get into the third episode. And in this episode, I really want to quickly just run through Tradingview, like maybe 2 minutes on how to use it. Then I want to mention MetaTrader 5. And then we're going to get to the two main topics for today, which is candlesticks and also different types of orders. So as you can see on the screen right now, I've done like so many takes, that's why I'm drinking water. So Tradingview, if we start on it, I'm going to give you a very, very basic explanation on how to use this. There's very in-depth tutorials on YouTube, and I believe I've got one as well. Up here, right there, we have what we are trading. The instrument that we are trading is always written there. So Euro USD, Euro dollar, that's what we are trading. Next to it is the time frame we're on. Are we on the 5-minute time frame, the 10-minute time frame, 1 hour, daily, all those good things? And the third is the brokerage. Where are we getting this data from? And there's many: 8cap, Forex.com, FXCM, all of those good things. And over here, the OHLC is to do with candlesticks, which we will get onto later, but that's pretty much TradingView. On the side, we have the toolbar. You can get things like trend lines, Fibonacci's, writing tools like I've got here. And all you have to do is click here, and then you can click the star as well to favorite it. And now favoriting basically just adds it onto this area. And in this area is your favorites bar. So you don't have to, constantly search that, or where's this tool, where's that tool? Everything is on the favorites bar. So now that that's out of the way, what else do we have? Is anything more? On the right is your watch list. All your pairs, current instruments, whatever you're trading, commodities, all of that will be listed here. You can just quickly, browse through that. And apart from that, there's nothing much. I mean, we have the indicators right there. You can click that and then search your indicators, but I'm a pure price action trader, so I don't really use indicators. But that's enough for TradingView, I think. Now, getting on to MetaTrader 5 and MetaTrader 4. These are the platforms that you are actually going to execute your trades. So I'm not going to go through that. It's a pretty boring thing, but there are many videos on YouTube which you should check out on how to use MetaTrader 5. But your actionable step, for your practical step to do right now, actually, you can pause the video and do it now. Go on TradingView, create an account and get all of this ready. Then go on MetaTrader 5, MetaTrader 4, download it to your Mac or Windows and get that ready as well. So now that you've got those two things done, we can move on to candlesticks and different types of orders, which is the main aim of this video. So different types of orders. When we're buying and selling currencies, we have to execute, right? But there are different ways of executions. We can't just buy and sell. Well, you can, but there's many ways of doing this. So to start with, let's go with the easiest one, which is called a market order. Now, a market order, as I just said, is basically just buying and selling at the current price that the market's at, So if euro dollar is currently at this price right now, and I want to place a market order, then all I have to do is buy and sell, and it will take me in the price that my entry is will be the current price on the dot, right? That is a market order. So you're basically executing or buying or selling the market, longing or shorting the market at the current price that it's at. That is a market order. You could also think of it as an instant order because it's instant, right? The downsides to this is that because it's instant, the brokers have to be on it. Therefore, the commissions can be high with the market orders, which is why people tend to use limits and stop orders, which we'll get to now. But market order is instant price executions at that current price. You'll be taken into the trade. No waiting, no delaying, nothing like that. Yeah, make sure to like this video so more traders just like you can actually access this and learn and have a proper framework to reach a funded level status. Now, limit orders, buy limit and sell limit. Now, before we just get onto this, I want to introduce you to a tool called the risk to reward ratio tool. We'll get to this more in the risk management section of this course, of the series, but it's basically this. When we're shorting the market, we have this. And when we are buying the market, we have this. Now, all this shows you is that the red area is your risk, okay? When you're in the red, that means you are in drawdown. And same thing here, when you're in the red, you're in drawdown, right? This is for the buy position because obviously being in profit means we're going up. And in here, being in profit in the short position means we're going down. So, and this area right here in a short position is your stop loss. As you can see, it says stop right there. And here is the profit target or the take profit level. So take profit at the bottom, stop loss at the top, and in a buy position, stop loss at the bottom right there, and take profit at the top. So now that's out of the way, I'm just going to show you how we can enter the market in different ways using this risk to reward ratio tool. I'm not going to dive too much into risk to reward because that is more, risk management. That'll come later on, but I will talk about different orders. So buy limit order, what is a buy limit? So first of all, let's break this down. Buy limit already indicates that we want to buy the market. Okay, we're not shorting, we're not bearish, we are bullish and we want to buy the market. So since we want to buy the market, we can place a buy limit order. But what does it actually mean? All it means is that, let's say price is like this. It's moving like this, right? And currently it's at this line. So this is where price is currently, and you know, it's fluctuating up, down, anything. But let's say it's somewhere there. Okay. If I want to place a buy limit order, all that means is that I'm waiting for price to come down eventually, hit my entry point, and then I'm in the trade. It can go down, take me out. It could hit my stop loss. I could lose money. That's out of my control. All I'm saying is that I want to be entered in the market at a price which is lower than current. So getting the risk to reward ratio tool out, this is what it would look like. By the way, this is your take profit, as I mentioned before. This is your stop loss, and the middle line is your entry point. Okay, so this is what a buy limit would look like. Right there. So now, price is here. We are waiting for price to eventually come down, hit our entry point, and then we are officially in the trade. So a buy limit would look something like this. There, it hits the entry point. Maybe we're in a bit of drawdown. Okay, a bit more drawdown, and eventually hits our take profit level. So this is a buy limit. Price was at the start initially there. We placed a buy limit, which means that we waited for price to come down to eventually go up. It's a limit. We're waiting for price to come back and then go up in the desired direction, which in this case, buy limit. So the desired direction is bullish. Now, sell limit, if you're catching on, you're probably going to know what this is. But in a bearish scenario, let's say price is currently here, somewhere there. That is where price is at currently. Then all we're going to be waiting for is price to come back to a specific area, and that's all with technical analysis, which area to enter at. But that's not what I'm trying to drive here. I'm just trying to show you what these different types of orders actually are and how they look like. So price is currently here. We've got a sell limit order placed right there. This means that we are waiting for price to eventually come back, tap this area, then we are officially in the trade. Then hit the take profit, which is obviously not always going to happen, but that is the outcome of the trade, and that is a sell limit order. So buy limit, we're looking for prices to go up, number one. Sell limit, we're looking for prices to go lower. Okay. Limit order, all it means is we're waiting for price to pull back, come back, take us into the trade, hit our entry point, and then go in the desired direction. So we've covered market orders, we've covered buy limit orders, sell limit orders. Now the last two, which is very, very easy, sell stops and buy stops. Now, I'm not going to dive too much into this, but if you know what breakout strategies are, then this is what they'll be using. But essentially all it is, if we get that example out again, this. In a bullish scenario, we're looking to buy, obviously. But in a buy stop order, we're not looking for price to pull back. We're not looking for this, okay? All we're looking for is price to continue going up, like so. So a buy stop, we're not waiting for it to come back. So our entry point will be above the current price, like so. So if the current price was here, let's say, okay, this would be a buy stop order. The moment price hits this area, we are in the trade. It's above. We're not waiting for it to come back, right? It's above. It hits it, and then we're in the trade like that. In a sell stop, it's the same thing, but just the other way around. Let's say price is coming down like this. We are not going to wait for price to come back, tap an area, and then go down. Why? Because that will be a sell limit. What we're going to be looking for in a sell stop is price to continue going down, and that's why our stop, so our entry point will be underneath, below the current price. So it looks something like this. We're not going to wait for something like that to happen. All we're going to do is wait for price to do what it has to do, hit the entry point, and then, do what it has to do. So that is a sell stop, buy stop, and rewind the video, maybe go through it again, take some pictures, add it to your notes. I really encourage you to do this, but mostly in the strategy and the way I'm going to be teaching you guys, we are going to be using buy limit and sell limit orders. In the rare occasion that you might miss a trade or you're late to the charts, then you can use sell stops and maybe even market order, but majority of the time we're going to be using buy limits and sell limit orders. So now that is out of the way, we can get to the interesting stuff, which is candlesticks. Now, candlesticks is a type of chart. Okay, we have line graphs, we have bar charts, and now we have candlestick charts. Okay, so above here you can see that we have different types of charts. We have a line chart right there, so it turns it into this, but we all use candlestick charts. But what does a candlestick even mean? So this is what a candlestick, a very generic formation, would look like. It consists of 4 different elements, which I'm going to go through right now. This is what a generic single candlestick looks like. It consists of a high, highest point of this candlestick. As you can see, it's right there. So what's this going to be? Yeah, it's going to be a low. High, low. Then we have this, which is called the closing price, and we have this, which is called the opening price. 4 elements to a candlestick: the open price, the close price, the highest point of it, and the lowest point of it, which relates me back to this, OHLC. Now can you guess what it stands for? Open price, which was this, the highest point of that candlestick, which was this price, the lowest point of that candlestick, which was this price, and the closing price of the candlestick, which was this price. So those are the 3 parts of a candle. But what does a candle represent? It represents, number 1, a time frame. So whichever time frame you're on, that is what each candle represents in price. It shows you the journey of what price did during that, I don't know, in this case 5 minutes. So in a 5-minute chart, all of these candlesticks, each separate candlestick represents 5 minutes of price action. And what did price do? Did it go up? Did it go down? Did it, not move at all? All that is represented by one candlestick on a 5-minute chart. On a 15-minute chart, each of these candles represents 15 minutes of price action. And then on a daily chart, each candle represents 1 whole day's worth of price action. What did price do? What did price get up to in that full day's worth? So let's go back to the, 5-minute? Yep. So those are the 4 elements: high, open, close, and low. But why are candlesticks different colors? And ignore my colors right now because, they just change every time. But generically, red and green. Red means down, green means up. So if a candlestick is red in color, what does this mean? It means that, it gives you a sign that it's something to do with going down, right? And you're right. All it means is that we opened at a certain price. Price did its thing, up, down, sideways, whatever. And then it closed at a lower price than it opened. That's why it's red. It's showing you that at the start of the candlestick, at the start of that minute, it was opening at this price. At the end of that minute, so in a 5-minute, the start of the 5 minutes, it opened at this price right here. And the end of the 5 minutes, it closed right there. So what's it showing? It's showing that it opened here, closed there, so it's closed below where it opened. So that's why it's red. Now looking at a bullish case, what can we see? The elements are the same, right? But all it's showing is that price opened here, came down and went up and then closed there. So it opened here, it closed there. Hence why it's green. Open, close, it closed higher than the opening price. Hence why it's a green candle. So if you look at a candlestick chart, you should be able to see that where did price open at, where did price close at. And if you want the actual figures, all you have to do is hover over a candle. So let's say I want this candle with this long wick coming out of it. If I want to know the price of each thing, the high, open, low, close, I just hover over it like this and then look over here. Okay, that is the price of every single element. So if I hover it, and now if you look at the OHLC, that shows the open, high, low, and close of that price. So that is candlesticks, like the very basic theory of it. But how do we know which candlesticks are strong? How do we know which candlesticks have, selling momentum, buying momentum, all those things? Well, this is what I'm going to show you right now. These little things coming out of the candlesticks are called wicks. And this shaded part, in both cases, is called the body. Wicks and bodies. Now, a candlestick which is very wicky, which is leaving a lot of wicks, is showing weakness in a specific direction. Whereas a candle which has got less wicks and more body is showing strong momentum in that direction. It's basically complete opposite. So look at this. Immediately you can see wicks right there. Long wicks, long wicks. What is this showing? Weakness. And what happens? Weakness to the upside. What happens? It comes down. And as you can see, we're still going down. But why is it showing weakness? What is about the wicks that's making it weak? Well, all a wick shows is the journey of the candle. So in this case, this wick, all it's showing is that we opened here, we went all the way up here at one point in time, okay? When it was live price, went all the way up here, and then we ended up going down. So it's left that trail of price, of what price did. Same thing in this scenario, opened here, went all the way up and then came down. Even this little one came all the way up at the start and then came down. So all it's showing is that every time price is going up, they're selling pressure and it's pushing it down and it's leaving these long wicks. So this is a good indication that we are going to go down. In the same scenario, a long wick to the downside is showing that we're going to go up, or more likely to go up. So we open here, go all the way down, and then buyers push the market up and take it like this, leaving a long, large wick showing the trail of price and also buying momentum. So that is what I wanted to talk about candlesticks, and that's all you really need to know. You need to know the different elements of the candlestick, and you need to know what shows weakness in a candlestick and what shows momentum in a candlestick. strong buying momentum or strong selling momentum. So your actionable step, and what I want you to do in this section of the video, is go on your TradingView chart, which you already have an account because I told you to get it at the start of the video. So go on TradingView, and all I want you to do is go to this section, get a circle tool, and I want you to circle like that. I want you to circle 10 different wicks that you see, and I want you to circle 10 different strong candles which you see. Strong candles are candles with barely any wicks, such as this one. You can barely see a wick showing strong bullish momentum. So I want you to collect 10 examples of weakness shown in the markets by long wicks, and I want you to collect 10 examples of strong momentum in whichever direction, but I want you to circle that, and I want you to note it down so you can get better at improving and seeing when there's weakness and strength in the market without relying on an indicator which is lagging. So that is the actionable step, and that is the end of episode 3. Candlesticks, different types of orders, and the basic stuff I said at the start of the video. But so without further ado, there's nothing more to say from my side. Just make sure to take those examples. I do forecasts every day, so check those out, and I'll see you guys for episode 4, which I'm planning, and it's going to be a huge one, and it's just going to get better from here, honestly. So stay tuned, notifications on, and until the next time, happy trading.